Hi, everybody. I'm Steve McDonald, and this is your Investors Daily Edge midweek market update. Well, the pullback finally happened. I've been warning about it since late last fall. It took longer than I expected, but it was inevitable. The only question now is, what will cause the turnaround and how big will it be? From where I sit, the turnaround will be muted at best. As I said last week, plan on the market having major ups and downs this year, which will result in little to no growth. Last fall, when I saw this shaping up, I advised my Sound Profits readers to buy dividend-paying stocks, which is all I've been recommending in Sound Profits, and investment-grade corporate bonds at a discount if possible with very short maturities. And this is for a variety of reasons. The thinking was that we were heading into a market where all you might see for some time in returns is the dividends from those stocks and the interest from bonds. The foundations the market requires for healthy growth are not there. Consumer confidence, jobs, and business spending. Without these, you have a house of cards. I do believe the foundations are taking shape now, but they are well out in the future, maybe 9 months to a year from now, before we see any solid market fundamentals. In the meantime, I believe there's a lot of money to be made in oil. I know I mentioned this last week. I'm going to reiterate it. Last spring, when oil was in the 30s, I said that it would go to the 75 range. My reasoning then is the same as it is now. The oil companies will make this price go up. Why? Because they can. I am convinced we're going to start seeing articles and news stories very soon implying a shortage in the pipeline, increasing demand with the dwindling surprise, and probably another Nigerian rebel attack or a terrorist threat to a pipeline. They're going to put out there whatever it takes to make people think we have an oil shortage. It is all manipulation, and it is coming. Oil will not stay at $72 or $73 a barrel. If things go badly with the Iranian nuclear issues, or if we see a spike in the rate of recovery in the world markets, we could see a big, and I mean a very big jump in oil. The previous highs are not out of the question. As always, time is our ally here at Sound Profits, not our enemy. Give this time to develop. Use a fractional buy discipline that I talk about all the time in Sound Profits and let this thing develop. See every dip as a buying opportunity, and there's going to be a lot of them in the next year. The best play is a single or a double oil ETF. Now, there are plenty of these to choose from. Just search oil ETF on Google. You probably have about 15 to choose from. Now, the pigs, that's Portugal, Italy, Ireland, Greece, and Spain, the pigs-driven instability in the sovereign debt markets is making a gold play more attractive to me. I've never been a gold bug, but this is starting to look good. Now, any foot dragging on the part of the EU will drive gold prices significantly higher. Combine this with the U.S.'s budget and debt problems, and we could have a big run from this current price of around $10.50 to $10.60. Look at the gold miners. They will probably give you a better return than hard gold. Now, as I mentioned last week, one of the keys to this whole economic recovery worldwide is China. Their credit tightening a few weeks ago was the stimulus for this pullback we have right now. But Andy Gordon, one of Investors Daily Edge's resident analysts, says, hold on, this isn't bad news. China tightening credit is good news, and the market has it backwards. For those of you who don't know Andy, he's a 30-year veteran of the markets, and he spent most of his career in the international arena. He's here today to talk about China and what he says is the upside of their credit tightening. Welcome, Andy.
Thank you, Steve. Good to be here.
So, China tightens, the markets sell off, but you say this is a positive. Why?
Well, I do. I think China is doing the right thing at the right time. I mean, their economic growth expanded by 10.7% last quarter. That's good. Maybe it's
10.7, yeah.
10.7. I mean, those numbers are unheard of in the West, of course. But I think it's a little too fast, and they have some concerns of inflation, of emerging bubbles. So they're tapping on the brakes. But what you hear, the craziest stuff, you hear that China is like Dubai, but it is like Dubai, but 1,000 times worse. They're slamming on the brakes. No, they're just tapping on the brakes. Lending is still projected to be $1.1 trillion this year. I mean, that's enormous. That's just a little less than last year, and last year was incredible. So it's not as if they're just, bottlenecking liquidity and making moves that will put a stop to economic growth. They're not doing that at all.
Okay, so it's healthy.
Oh, it's very healthy. Yes, I think
So
yeah.
you're long China. What do you like?
Well, I like not Chinese companies directly because it's still a volatile market. There's still a lot of nervousness, as we've seen the past few days with the market, with the U.S. market, with the emerging market. So I like the big globals, and I like the fast food companies. I like the companies that are playing on China's enormous urbanization trend. You know, there's about 20 million people moving into China's cities every year. That's equivalent.
20 million a year.
That's the equivalent of 7 Chicagos being created every year. Yeah, wouldn't you want to be one of these global fast food companies already there, already established, and having these customers being created for you every year? It's a great long-term play.
How about the market here at home? You give us a call on it?
Yeah, the market, it's a little tricky here at home for the reasons that you've said. But I have just one quibble with you. That is that earnings came in very well last quarter. It was surprisingly well.
They were good earnings.
That's right. About 3/4 of the companies in the S&P 500 exceeded expectations. That's pretty good. But they did it more on savings, slashing costs.
Right. This is what I'm talking about when I say I don't see the foundations of real growth yet.
That's right.
We see people cutting jobs. We see people cutting costs. We see people improving their efficiencies. We don't see anything growing.
Yeah. So it's a little tricky market. I would go with the big multinationals that have a lot of their revenue coming from outside the U.S. I think that's a safe play these days.
Couldn't agree more. Thanks so much for being with us.
Sure, my pleasure.
Before we take off today, I've got 2 things for you. First, the Slap in the Face Award this week doesn't go to a big bank. I wish I could give it to them, believe me, but it's going to Toyota. Don't worry, I'm sure the banks will be back in the running next week. Ford, GM, and Chrysler might have made some not-so-great cars in the past, but today they're quite good, actually. But at least the brakes worked and the accelerators didn't stick at max power. How can it have taken Toyota so long to address problems like these? This wasn't a light that came on when it wasn't supposed to, or a rattle in a door. This was a case of a family of 4 who were killed when their Camry's accelerator stuck wide open. People have died and been injured when their brakes failed. This slap in the face award doesn't describe what they should receive. Their response this week, the CEO's response this week to all the criticism and the recalls was, we will work more closely with the U.S. regulators in the future. Shame and disgrace is closer to what they deserve. And their stock is still in the mid-70s, down only 15%. Go figure. It looks like a very long-term short to me. I can't imagine this company is going to recover quickly from this. Take a look at what happened to GM and Ford after Nader pointed out problems with their cars. And none of these problems were anywhere close to what Toyota is facing right now. Could this be the break Ford, GM, and Chrysler have needed and been waiting for? It could be a major crack in Japan and this behemoth that we now see as the Japanese car makers. Lastly, here in Baltimore, we're expecting, this is unbelievable, because we don't know what to do with it. We're expecting 12 to 20 more inches of snow on top of the 30 we just got Saturday. If any of you folks from the Great White North have any suggestions of what to do with all of this, I'm all ears. Oh, by the way, did I mention that we average 18 inches of snow a year, and we've already had 30 or 62 inches before we get the 20 we're expecting tonight? And I think all 3 or 4 of our snow plows are up and running today. That's about it for this week. If you have any feedback, we'd love to hear from you. The email address is down below. If you haven't subscribed to Sound Profits, I know I talk about it here a lot. It's one of my favorite publications. It'll be the best $49 you've ever spent. For everybody here at Investors Daily Edge, I'm Steve McDonald. Thanks for being a part of us.